Welcome to Note Lab Mode, your shortcut to being truly well-informed. Today, we're diving deep into some really talked about investment predictions. We're looking at the bold forecasts from Cathie Wood, the founder and CEO of ARK Invest. Our mission today, it's simple. Unpack the real odds, the actual risks behind these potentially huge opportunities.
Right, using solid research.
Exactly. Backed by comprehensive research to give you the clearest, most, realistic picture. Now, these predictions, they've really grabbed headlines, haven't they? Especially after she was on the Diary of a CEO.
Oh, definitely. Big splash.
She laid out specific investments she thinks could deliver, extraordinary returns. We're talking 15x, maybe more, over 5 years.
Those are the kinds of numbers that get attention.
They really do. It sparks excitement, sure, but also, a healthy dose of skepticism. So what does that actually mean for you, for your portfolio, your financial future? Well, to answer that, this deep dive uses a really thorough analysis.
Yeah, this isn't just back-of-the-envelope stuff.
No, exactly.
Yeah.
It combines rigorous quantitative financial work, advanced risk modeling, probability projections.
Monte Carlo simulations too, right?
Yes.
Eh?
Running thousands of potential scenarios, plus scenario analysis, looking at different futures for these companies. It's all designed to give you that data-driven reality check. Cut through the hype.
Get to what really matters.
This is your guide to understanding these high-growth, high-stakes predictions.
And today's deep dive is brought to you by CloutFit.ai. Imagine connecting influencer outfits directly to your product inventory.
Making their content instantly shoppable.
Exactly. Driving more sales, higher order value. That's what CloutFit.ai does. Visit CloutFit.ai to learn more. That's CLOUTFIT.ai. Okay, let's unpack this before we get into the specifics, the actual forecasts. It feels crucial to understand Cathie Wood's core philosophy, her investment thinking, and, what does the track record tell us?
Absolutely. You need that context. Her whole philosophy really centers on disruptive innovation.
Right, not just any growth. No, she's looking for companies that are fundamentally changing the game. The focus areas are pretty clear. AI and robotics.
Okay.
Energy storage, battery tech, blockchain, digital assets, genomics, gene editing, and even space exploration.
So the big frontiers.
The big frontiers. And her unique angle is targeting companies at the convergence of these trends.
Convergence, where they meet.
Exactly, where multiple innovations intersect. She believes that's where you find that, exponential growth potential.
Okay, so that's the philosophy. What about the performance?
Yeah.
The history.
Right, the track record. So looking at ARK Invest from, say, November 2014 to May 2025, the compound annual return was 12.92%.
Which sounds pretty decent on the surface.
It does, but you have to connect that to the volatility. It's been an extremely wild ride. The research points to a standard deviation of 31.48%. That's huge fluctuation.
Wow.
And a maximum drawdown, the biggest peak to trough drop of a staggering minus 69.47%.
69% loss.
Yes. And that drawdown has actually persisted for 52 months.
Over 4 years to recover from the low point.
Essentially, yes. Think about ARK, their flagship fund. It had that incredible 140% plus return in 2020.
Everyone was talking about it.
Followed by really substantial losses in the years after. It just shows this isn't a smooth ride-up.
So high risk, high reward is putting it mildly.
Precisely. It's a roller coaster.
Okay, so definitely more roller coaster than steady climb. That context is absolutely vital for looking at her current predictions, isn't it?
It really sets the stage for managing expectations.
Right, because the allure here isn't just the big numbers. It's the idea of finding the next big thing, the next Tesla or Amazon.
That's the dream she's selling.
And she's pinpointed specific ones. Tesla, Coinbase, CRISPR Therapeutics. She thinks they could hit 15x or more. But how do those dreams stack up against, the data? Let's dive into the analysis.
Yeah, and to really assess these bold claims, the research used a pretty robust framework.
More than just looking at price charts.
Oh, much more. Detailed financial analysis of each company, comprehensive risk assessment, technical risk, market risk, regulatory.
All angles.
Rigorous probability analysis on hitting those targets. And, crucially, those Monte Carlo simulations we mentioned.
Running thousands of what-ifs.
Exactly. Thousands of market scenarios to get a realistic range of outcomes, plus scenario analysis for different company futures. It's about seeing the whole spectrum.
Okay, let's start with Tesla. TSLA. It's been a core holding for ARK for a long time.
A cornerstone, definitely.
And her prediction is audacious. $2,600 per share within 5 years.
Yeah, compared to around $329 now.
That's a 690% return, almost 7x your money. It definitely makes you look twice.
It does. But the key assumption driving that huge target is, well, it's pretty specific.
Okay.
ARK's model basically assumes that by 2029, roughly 90% of Tesla's value and earnings will come from its robo-taxi business.
90% from robo-taxis, not from selling cars.
Their model suggests traditional EV sales would only be about 10% of the value then.
Wow. Okay, so it all hinges on robo-taxis.
It fundamentally relies on Tesla launching a successful robo-taxi service and doing it soon, like within the next 2 years. And that service achieving massive scale and profit.
That sounds like a tall order.
It faces significant hurdles, according to the research. First, there's huge technology risk.
Getting the self-driving truly right.
Exactly. Full self-driving, proven at the scale you need for a profitable robo-taxi network, still not there. Handling complex city streets, bad weather everywhere, it's tough.
And competition.
Intense competitive risk. You've got the legacy automakers GM, Ford pouring billions in, tech giants Waymo, Apple, Amazon are circling, and specialized AV companies like Cruise, Aurora.
Everyone wants a piece of that pie.
Everyone. And then there's regulatory risk. That's a massive question mark. Getting approval for fully driverless cars. The path is really unclear, state by state, country by country. Safety is paramount for regulators.
So lots of hurdles. What does the research say about the actual probability?
The reality check is pretty stark. The analysis puts a probability of Tesla actually hitting $2,600 in 5 years at only 15%.
15. 1-5.
1.5%. And when you adjust for that low probability, the expected return plummets.
Okay.
It's not that shiny 690% potential. It becomes a much more grounded 103.5% expected return once you factor in the likelihood of overcoming those hurdles.
Wow. That 15% probability versus 690% potential, that's a massive gap. What's the biggest single reason for that difference? Is it just the tech?
It's really the sheer scale and speed needed for the robotaxi vision. It's not just one breakthrough, it's multiple breakthroughs, plus massive operational execution, plus regulatory green lights, all happening incredibly fast.
Like everything has to go perfectly right.
Almost perfectly. For fund managers, seeing that 15% number, unless they have extraordinary conviction in Tesla clearing all of those specific huge hurdles, they just wouldn't bet the farm on it. The chance of failure is too high.
Okay, got it. Let's pivot then from robotaxis to crypto. Coinbase. Coinbase, that's Wood's big bet on digital asset growth.
Right.
Her target here, $400 a share. From around $262 now, that's a 52.9% return. Still good, but more modest than Tesla.
Relatively speaking, yes. Coinbase's business is mainly crypto trading fees, subscriptions, custody. So its fortunes are really tied to crypto trading volume and prices.
Makes sense. And the big factor there has to be regulation, right?
Absolutely huge. It cuts both ways. On the plus side, you had the Bitcoin ETF approvals. That definitely helped institutional adoption, added legitimacy.
Okay, positive.
But the challenges are still significant. Ongoing SEC actions against crypto projects, that whole uncertainty about whether tokens are securities or commodities.
Still murky.
Very. And regulations vary wildly internationally. Plus, you've got growing competition. Traditional finance players like BlackRock are moving in now. Other crypto exchanges are fighting hard too.
So headwinds and tailwinds, what's the probability here?
Considering all that, the research puts a 35% probability on Coinbase hitting $400.
Okay, 35%. That's notably higher than Tesla's 15%.
It is. It reflects perhaps a less extreme set of assumptions needed for success compared to the robotaxi dream. But still, 35% isn't exactly a sure thing.
No. And the probability adjusted return?
That comes out to 18.5%. Again, way down from the 52.9% potential target return.
Right. So even with the highest probability of the three, the expected gain is much smaller. This really hammers home that probability point.
It does.
But how do these different probabilities, 15% for Tesla, 35% for Coinbase, how do they play out when you put them together in a portfolio?
That's the million-dollar question, isn't it? Looking at them individually only tells part of the story. When you combine them, you have to think about correlation. Do their risks move together, and how do those probabilities interact? One might succeed while the others fail. The overall portfolio result isn't just adding up the potentials, it's a complex blend based on likelihoods.
Okay, let's look at the third one then. CRISPR Therapeutics, CRSP. This is Wood's play on the genomics revolution.
The gene editing frontier.
And the target here is really ambitious. $268 a share. It's around $42 now, so that's a massive 544.5% return potential.
Huge upside potential, yes. CRISPR Therapeutics is a leader in CRISPR-Cas9 gene editing.
Explain that quick.
Think of it like molecular scissors for DNA. It lets scientists precisely edit genes, opening the door to potentially curing serious genetic diseases.
Okay.
And they had a huge win. FDA approval for Casgevy in December 2023, first CRISPR-based therapy approved for sickle cell and beta thalassemia, a massive validation.
That sounds incredibly promising. But biotech is tough.
Incredibly tough. The research highlights major challenges and risks. There's still technology risks, things like off-target edits, making sure the scissors cut only where you want them to, and delivering them efficiently into the right cells.
Right. The science is still evolving.
Then there's huge clinical development risk. Biotech trials have notoriously high failure rates, even after promising early results.
The valley of death for drugs.
Exactly. And regulatory risk is always there. The FDA approval process is long, costly, uncertain. And competitive risk is fierce other gene editing firms like Editas, Intellia, Beam, plus Big Pharma is jumping in.
So another set of significant hurdles. What's the probability assessment for CRISPR?
Given all those factors, the research assigns a 25% probability to CRISPR reaching $268 within 5 years.
95%.
Yes. And again, adjusting for that probability, the expected return becomes 136.1%. Still substantial, but nowhere near that headline 544.5%.
Okay, 544% potential, 136% expected. Still a big potential reward, but the odds are still, what, 1 in 4?
Roughly, yes. High stakes.
So let's put it all together now. Tesla at 15%, Coinbase at 35%, CRISPR at 25% probability. What happens when you combine these into, say, an equal weight portfolio?
This is where the analysis gets really illuminating, maybe even a bit sobering.
Uh-oh.
Well, first, the headline number. If, by some miracle, all three hit their targets, Tesla, Coinbase, and CRISPR, an equal weight portfolio would return a fantastic 429.1%.
Okay, that's the dream scenario.
That's the dream. But, and this is the critical insight the research emphasizes, when you factor in those individual probabilities of success for each stock.
Right, the 15%, 35%, 25%.
If the portfolio's overall expected return drops drastically, it falls to 85.8%.
From 429% down to 86%. That's a huge adjustment.
It's massive. It shows the profound difference between theoretical maximum upside and what's actually probable.
So what does that mean in real dollar terms for an investor?
To make it really concrete, the research ran those Monte Carlo simulations on a hypothetical $100,000 investment split equally across the three.
Okay, let's hear it.
The results are, well, eye-opening. The mean expected return over 5 years is actually negative 3.8%.
Minus 3.8%. The average outcome is a small loss.
On average, yes. And the median return, meaning half the simulations did worse than this, is negative 69.2%.
Minus 69%. Wow.
Yeah, extremely high volatility too, standard deviation of 141.3%. Huge swings.
What are the chances of just making any money?
The probability of seeing any positive returns at all is only 36.2%.
So roughly a 1 in 3 chance of being in the green.
Correct. And conversely, the probability of losing more than half your investment is 52.1%.
More likely to lose half than to make anything.
Based on these simulations, yes. And there's even a 12.3% probability of a total loss.
Gulp. Okay. That paints a very different picture.
It really highlights what the research calls an asymmetric risk-return profile. Small chance of huge gains, much higher chance of significant losses.
And these risks can compound.
They can be correlated. Remember, they share underlying risks, tech sentiment, regulatory shifts, overall market conditions for growth stocks. A downturn could hit all three.
So the suitability assessment. Who is this actually for?
Look, these are clearly extremely high-risk speculative positions. The research is blunt. They are suitable only for investors who can genuinely afford to lose their entire investment in them.
This is not your retirement nest egg.
Absolutely not. Not for retirement, not for emergency funds, not for anything you can't afford to potentially see go to zero.
What about allocation guidelines?
The research suggests clear limits based on risk tolerance. Conservative investors, probably 0%.
Oh.
Moderate risk, maybe 2-3% max of your total portfolio. Aggressive growth, perhaps 5-10%.
And speculative.
Maybe up to 15%, but only if you fully, truly understand and accept that high probability of loss. And again, this isn't specific advice, just guidelines based on the risk profile identified.
Those Monte Carlo numbers. A median return of minus 69%. That's just staggering. It really changes the narrative from huge potential to huge potential alongside potentially devastating risk.
It absolutely does. The takeaway for someone just hearing the headline is crucial. Understand that potential often comes with very low probability.
Like buying a lottery ticket almost. You see the jackpot, not the odds.
It's a similar dynamic, yes.
Yeah.
The research shows that while the upside can be life-changing, the likelihood is low, and the potential downside is very real and very significant. These are speculative tools, not foundational building blocks for most investors.
Okay, so let's wrap this up. The core takeaway for you listening right now. Cathie Wood's predictions offer this incredibly exciting vision of the future and potentially massive gains.
The allure is strong.
It really is.
Yeah.
But this deep dive into the research shows these opportunities come packaged with exceptionally high risks and, critically, pretty low probabilities of hitting those headline numbers.
And the probability-adjusted returns, the expected outcomes, are far, far more modest, often dramatically so.
Yeah. So these are highly speculative plays.
Extremely. Only suitable if you have a very high risk tolerance and, frankly, capital you can afford to lose completely without it hurting your overall financial health.
Right. Understanding the odds, fitting it into a broader, diversified strategy if you do participate, and never relying on these kinds of bets. That seems key.
That's the prudent approach, definitely.
So here's a final thought to leave you with. In this world that's constantly buzzing about innovation, about the next big thing, these grand predictions,
Yeah.
balance the thrill of revolutionary change with the kind of analytical rigor we've talked about today. The kind needed to navigate the real-world financial implications. What's your framework for assessing these truly disruptive opportunities when the hype collides with the hard data? Something to think about. If you found this deep dive valuable, please share it with a friend who loves to learn, especially one who understands the difference between potential and probability.
Yeah, spread the knowledge.
And don't forget to subscribe to Note Lab Mode for more insights like this one. Thanks for tuning in.